Now, according to Scott Bessent, you could take those $5 to Fort Knox and they will hand you 5 silver dollars, which are worth about $60 a piece, $300 worth of silver.
It's an interesting thought process because on one hand, if you put silver at $200-300, your mind goes to, oh shit, what's going to happen to industry? Mm-hmm. What's going to happen to all these manufacturers? But you look at gold, and if I would have said to you 3-4 years ago, when gold is $1,000, gold goes to $5,500, is there going to be blood in the streets? Most people have said, hell yeah, it's going to be crazy, right? But it wasn't. So at 7 or 8 or 9,000, does that mean life goes on? It kind of seems like it does because of what you just said, because gold has virtually no industrial uses. It's just universally accepted as money, as a monetary asset.
Historically, silver certificates were paper banknotes that could be exchanged directly for precious physical metal at the U.S. Treasury, serving as an absolute monetary promise. Today, these historical items function entirely as fiat currency, stripped of their unique metal conversion rights due to mid-century executive legislative adjustments. Peter Schiff, a prominent asset manager alongside Andy Schectman, a leading precious metals dealer, exposed the deep historical flaws regarding modern institutional claims about ongoing gold and silver redemptions. Schiff details how executive actions completely terminated gold conversions in 1933, followed by the definitive cancellation of silver exchanges in 1968. Consequently, the paper currency supply has suffered a massive loss in purchasing power over the past several decades, as real asset values surged. Data-driven financial projections indicate that continuous unbacked government asset creation will trigger severe commodity strain, pushing physical silver prices toward a projected $300 per ounce, while driving gold values upward into a target range between $7,000 and $9,000 per ounce. The ongoing degradation of fiat monetary systems strongly implies that hard tangible assets will serve as the ultimate vehicle for long-term wealth preservation. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I want to talk a little bit about what I heard our Secretary of the Treasury, Scott Bessent, say on Fox News. He was being interviewed by Jesse Waters, and he was taking him on a tour, I guess, of, and on the wall there were framed old Federal Reserve notes prior to 1968 or prior to 1933, where you had silver certificates and gold certificates, where it was legitimate currency, IOUs, redeemable on demand in gold or silver coins. And so Scott Bessent is walking down the hall, pointing this out to Jesse Waters and explaining to him, how our currency changed, how it used to be backed by gold and silver, and how now it's just fiat currency, right? Which is true. Of course, it's all unconstitutional. He didn't get into that. But the reason I'm bringing this up is he then told Jesse Waters that if any of these old notes still exist, right, the silver certificates or the gold certificates, he said, if you have one of these, you can bring it to Fort Knox and you could get your gold. You could get your silver. He actually believed that these silver certificates are still good. They're not. How could he not know that? Now, I guess I can forgive the average guy or gal on the street might not know that, right? That the government repudiated these notes years ago. It was Roosevelt, 1933. Roosevelt said, if you have a gold certificate, you can no longer get any gold. You can't get gold for your gold certificates. The silver certificates remained good until 1968. But after 1968, those were no good either. You could not get any redemption. Maybe your typical guy, especially somebody who went to a government school, like what the hell do they learn? So they might not know anything about the monetary history of the United States or the Federal Reserve. But if there's anybody in the Trump cabinet that you would think would know this, it's the Secretary of the Treasury. I mean, he's the guy that actually signs the bills, right? He's supposed to know about the history of our money. And he thinks he does because he's explaining it to Jesse Waters as if he knows, yet he is completely wrong about something that's so obvious. I mean, I can't even remember when I originally learned this, but I've known it pretty much my entire adult life. I'm pretty sure when I was still in junior high school, I knew that you couldn't take these notes in for redemption. In fact, when Scott Bessent said if any of these things were around, there's lots of them. There are a lot of these certificates. I went on eBay and that, you could buy them on eBay, and I saw one set that was framed, right? So you could buy it with the frame, and it had 3 silver certificates, 2 $2 bills and a $1 bill. So that means that you could get 5 silver dollars back in the day, right? You could have gone to the government, handed them that, a $2 bill, and they would have given you 2 silver dollars. You either get, a Morgan silver dollar or a Peace dollar, right? You got real silver. You could buy those 3 bills. They were selling them in the set. It was like $31, $31.95 or something like that. That includes the frame and everything. Now, according to Scott Bessent, you could take those $5 to Fort Knox, and they will hand you 5 silver dollars, which are worth about $60 a piece. $300 worth of silver. According to Scott Bessent, you could do that. I mean, it would be funny if somebody had that video, put it on their phone, went down to Fort Knox with some of these old certificates and said, hey, I'm here to get my silver. Scott Bessent said, I just have to bring them down and you'd give me my silver. Now, of course, a lot of people, when I pointed this out on X, people were saying, oh, come on, Peter, he didn't really say that. He really said that. That is exactly what he said. Go on my X feed. I reposted the clip. The person who posted it didn't even pick up on it. I reposted somebody else because in the same clip, he said that, hey, he's been down to Fort Knox and all the gold is there. So don't worry about it. It's all there. Well, I'm not going to believe anything he says. If he doesn't even realize that the gold certificates are no longer valid and you can't get redemption or in the silver certificates, why should I believe him on what's in Fort Knox? But the person who posted it just focused on that point. Hey, how do we believe this guy? But the minute I'm listening to it, I'm like, oh my God, how could the guy not understand something so simple? And then other people were saying, look, he slipped, he misspoke. No, he didn't. Listen to what he said. He was very clear. He believed that you could still get your gold and silver for these notes, that they were still good. Now, maybe he's confused by the fact that they're still legal tender. Yeah, I mean, if you've got an old $2 silver certificate, you can still spend it. It's still $2, but you're not going to get $120 worth of silver. And what that shows you is how much purchasing power the U.S. dollar has lost. Because in 1968, if you were dumb enough to keep the paper, then you still got $2. But if you converted it and got your silver dollar, you got, $60. The difference is the inflation, right? The difference is how much money the government has created between 1968 and now to pay for the Great Society, the war on poverty, the Vietnam War, and everything that's happened since, right? 70s, 80s, all these expenditures. That's why the dollar buys so little, because the government robbed so much of the purchasing power.
It's an interesting thought process because on one hand, if you put silver at $200-$300, your mind goes to, oh shit, what's going to happen to industry? Mm-hmm. What's going to happen to all these manufacturers? But you look at gold, and if I would have said to you 3-4 years ago, when gold is $1,000, gold goes to 5,500. Is there going to be blood in the streets? Most people have said, hell yeah, it's going to be crazy, right? But it wasn't, right? Yeah. And so at 7 or 8 or 9,000, does that mean life goes on? It kind of seems like it does because of what you just said, because gold has virtually no industrial uses. It's just universally accepted as money, as a monetary asset. So it's an interesting thought experiment, one where higher price certainly put it to the test. When you're talking 40 trillion on top of another 160 trillion in unfunded liabilities, and if they were to let rates rise, if rates were to rise on their own, we run into a very, very big problem. Austerity to me is off the table. There's no way they can do austerity and normalize the balance sheet and let rates rise as if it were an organic situation to clean out the excess. If you do, you break everything through years of suppressed interest. You break the bond market, the stock market, the pension market, the real estate market, the insurance companies loaded with pension, with treasuries, etc. I think they have no choice but to fall back and choose inflation as a pathway. And if you do reindustrialize the country, as he is trying to say, Triffin's dilemma says you cannot have a strong dollar. You can't. So I think ultimately Warsh wants a weak dollar and low interest. This is how you would A, pay off the debt, B, you would reindustrialize. In order to reindustrialize and have a shot at selling products to the world, you cannot really have a strong dollar. So I think inflation is the path that they will choose, regardless of how disinflationary or flat out deflate this massive technology is. And it is. And I don't think we really know how much that will play out, but I think inflation will be much, much worse before it gets better over time with reindustrialization, with setting all the infrastructure up, with paying down the debt, with actually bringing back manufacturing. I think you could start to produce your way out of this problem and bring down inflation. But I think for the foreseeable future, inflation is, if I had to guess, will become a very ugly word over the next few years. And I don't see any way around reindustrializing this country, reshoring manufacturing with any hope of actually selling those products without inflation and a weaker dollar and lower interest rates being at the forefront.
The overall macro landscape suggests that the federal government will systematically choose systemic inflation over domestic fiscal austerity. Implementing strict balance sheet normalization or letting interest rates rise organically risks severely disrupting vulnerable bond markets, traditional pensions, and insurance holdings heavily exposed to long-term government debt obligations. A weaker currency framework appears highly necessary to support current institutional efforts focused on reindustrializing the domestic economy and reshoring local manufacturing capabilities successfully. Projections reveal that national inflation metrics are set to become increasingly severe over the next few years before any sustained, production-driven corrections can take hold. Economic data shows the M2 money supply expanding rapidly at a rate of 5.6% year over year, alongside an expanding Federal Reserve balance sheet that recently climbed by billions to cross the $6.74 trillion mark. This systematic expansion confirms that near-term monetary policies will drive prices up significantly, challenging manufacturing supply systems that rely on stable commodity valuation. Now, let's get back to the interview.
What caused inflation? What caused it? He said, I want a quick answer. And Warsh responded, monetary policy caused it. Yes, perfect. He admitted that the inflation that we have was caused by monetary policy. Well, who was in charge of monetary policy? The Fed. So Warsh admitted that it was the Fed. It wasn't COVID. It wasn't Putin. It wasn't supply chains. He acknowledged that the Fed caused the inflation. Now, again, as I said on the last podcast, the Fed didn't cause it by itself. The Fed had a partner in crime, and that was the U.S. Congress and the president, right? Because it was fiscal policy that he monetized that caused the inflation. So Warsh is accepting the Fed's responsibility, yet Congress is not accepting theirs. But then Kennedy followed up, and it was a great follow-up. He said, okay, is inflation, the high inflation, going to be there permanently? And Warsh said, nope, not on my watch. And then Kennedy said, okay, what are you going to do about it? Perfect. What are you going to do about inflation? And then Walsh said, I got 3 things that I'm going to do about inflation. And then he listed the 3 things. Number 1, he's going to make sure that the markets know that the Fed is serious about bringing down inflation. Right? And so then Kennedy said, okay, so you're going to talk about it. Exactly. They're going to talk. They're going to say, you know what? We're serious about bringing down inflation. The second thing they're going to do was take ownership of the inflation, which he basically did. We own it. We created it. And then say that the Fed has the power to do something about it. In other words, more talk. They're going to own it, and they're going to talk about what they're going to do about it. So of the first 2 things that he's going to do, it's just talk about it. Now he gets to the third thing that he's going to do. He said, we're going to look at our tools, interest rates and the balance sheet, and decide if we need to make any adjustments. So they're going to talk and they're going to look. How does that count as what they're going to do about it? I mean, doesn't he know what he's going to do about high inflation? If he understands that the Fed caused it and its money supply and artificially low interest rates, why doesn't he say, we're going to shrink the balance sheet? We're going to jack up interest rates, because that's the only thing he can do. Instead, he doesn't want to do any of that. He's just going to talk. He's going to look, right? That's why I said it's all bullshit. Meanwhile, look at money supply, M2, up 5.6% year over year. That is not a Fed that's fighting inflation. That is a Fed that is creating inflation. Now, we haven't got the money supply numbers yet under Warsh. We'll get that, I think, in another week or so. We'll get the first monthly, because they release these numbers every month. and we'll be able to see what happened under his watch. But we have been able to see the balance sheet. Right? The balance sheet is there, and it's been growing. In fact, the most recent week, the Fed's balance sheet rose another $7.4 billion. The balance sheet went from $6.736 trillion to $6.743 trillion. So the balance sheet went up. It's expanding. Why is he doing that? In fact, he admitted that he was uncomfortable with the balance sheet in its current size. And he said it's so big, to him, it looks more like fiscal policy, which it is. It was the Fed monetizing government debt. So he knows the Fed's balance sheet is too big, yet he continues to make it bigger. So he can talk, but he can't act. And again, if the markets are not figuring this out, it should be obvious, because if Walsh did what he needed to do, the markets would be crashing if he did it. That's why he's doing it. That's why he set up all of these task force to study a problem where the solution is obvious.
Monetary policymakers bear direct responsibility for generating the modern inflationary environment rather than external global supply chain disruptions. Congressional spending programs rely directly on the central bank to monetize massive public debt accumulations, which ultimately strips real purchasing power from standard cash reserves. While administrative authorities claim they are utilizing standard baseline adjustments to control escalating market values, internal financial data shows systemic asset expansion continuing unabated behind the scenes. Future market indicators suggest that long-term commodity trends will place unprecedented stress on international industrial production systems. If gold successfully scales past the $5,500 target threshold without causing complete structural collapse, historical patterns point to an environment where asset valuation remains completely uncoupled from traditional manufacturing demands. Industry forecasts indicate that premium precious metals will perform strictly as universal monetary assets rather than raw industrial components as the broader currency base weakens. As institutional trust continues to erode globally, the structural shift toward undevaluable physical commodities will accelerate, leaving traditional paper assets heavily exposed to long-term systemic breakdown. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.